Imagine this. You wake up one morning, scroll through the headlines, and see bold warnings of an automotive apocalypse. They're saying 3 million used cars are about to flood the US market. A tidal wave so massive it could collapse prices, crush dealers, and change the way Americans buy cars overnight. It sounds like the perfect storm. Overflowing lots, desperate sellers, and buyers scooping up deals for pennies on the dollar. But here's the twist. When you dig into the data, the picture looks completely different. Instead of a market drowning in supply, the numbers show something far more unsettling. Inventory that's actually shrinking. Dealers are reporting their lowest levels of used car stock for this time of year in 3 years. That means instead of cars piling up, shoppers are fighting over limited options, and prices are holding strong or even rising. The so-called flood might not be a tidal wave at all. It might be a mirage. So what's really happening? Why are the headlines screaming apocalypse while the reality on the ground feels like a drought? And more importantly, what does this mean for you, the buyer who just wants a fair deal, or the seller who's wondering if now is the last chance to cash out before the market turns? Stick around, because this story isn't just about cars. It's about misinformation, hidden trends, and the surprising truth that could save or cost you thousands of dollars. It's easy to get caught up in the drama of headlines warning about a used car apocalypse, but when you pull back the curtain and look at the actual numbers, the story changes completely. Instead of 3 million vehicles about to swamp the market, the real figure is much smaller, around 2.2 million used cars currently in dealer inventory across the United States. That's a solid amount of cars, but nowhere near a catastrophic flood. And when analysts measure inventory, they don't just look at raw numbers, they calculate days of supply, which tells us how long that stock would last if no new vehicles came in. Right now, that figure sits at 43 days worth of cars, far from being excessive. That's the tightest supply level for this season in the past 3 years. To put it in everyday terms, imagine walking onto a dealership lot expecting rows of options, maybe even cars piled up waiting for desperate price cuts. Instead, you find the opposite. Dealers aren't struggling to move their inventory. They're moving vehicles so quickly that buyers are competing for the same cars. In many cases, cars are being sold almost as soon as they arrive. That 3 million cars flooding the market headline paints a picture of oversupply, but in reality, it feels more like scarcity. And this isn't just a technical statistic, it affects the entire buying experience. Shoppers hoping to score a bargain are walking into lots that feel emptier than expected, while dealers, aware of the tight supply, are holding firm on prices. The balance of power leans towards sellers, not buyers. Instead of a market collapse, we're seeing a market squeeze, one where limited supply collides with eager demand, and the outcome is anything but the fire sale many are predicting. But that raises the next big question. If inventory is shrinking, why are people talking about a crash? The answer starts to make sense once you look at what's happening with demand. If tight supply was the only factor, you'd expect buyers to sit back and wait, hoping for conditions to improve. But that's not what's happening. In fact, demand for used cars is surging, and the sales numbers prove it. In July alone, Americans bought 1.52 million used vehicles, a massive 9% jump compared to June and 7% higher than the same time last year. That kind of growth in the middle of a so-called apocalypse tells you something important. People aren't scared off by the headlines. They're out there buying, and they're buying aggressively. Part of this demand comes from affordability. With new cars still priced out of reach for many families, the used market has become the default choice. Rising tariffs, higher interest rates, and limited new car incentives have all pushed shoppers toward pre-owned vehicles. For someone who just needs a reliable car to get to work, a used model is the only realistic option, and that means demand doesn't just stay steady. It actually grows when supply is tight. This surge creates a strange dynamic. More buyers chasing fewer cars. Instead of prices cratering under a so-called flood, they're being held up, or even pushed higher, by competition. The result is bidding wars on certain makes and models, particularly fuel-efficient sedans, hybrids, and affordable SUVs. For buyers expecting to find deals after reading the doom and gloom headlines, the reality is a harsh wake-up call. And that brings us to the next piece of the puzzle. Because when demand collides with shrinking supply, there's only one direction prices can go, and it's not down. When supply shrinks and demand refuses to cool off, the outcome is inevitable. Prices rise. And that's exactly what's happening in the used car market right now. The average listing price for a used vehicle has climbed to roughly $25,500. But the real sticker shock comes when you look at newer models. A 3-year-old car is now averaging over $30,000, levels we haven't consistently seen since the peak of the pandemic. For many families, that's dangerously close to the cost of a brand new vehicle, yet buyers keep paying because they have little choice. This upward pressure isn't evenly spread across the market either. Budget-friendly sedans and compact SUVs are commanding strong prices because they appeal to cost-conscious buyers. Reliable brands with good fuel economy, like Toyota and Honda, are often gone from dealer lots within days, sometimes even hours, of being listed. The shortage is so acute that some dealers are reporting customers placing deposits on cars before they even arrive. That kind of behavior doesn't signal a crash, it signals desperation. What's more, these price hikes feed into a feedback loop. Shoppers who delay their purchase, hoping to wait out the market, often return a few months later to find prices have climbed even higher. Dealers, seeing demand continue to outpace supply, have no incentive to cut prices. Instead of collapsing, the market is squeezing buyers tighter, month after month. But not every corner of the used market is moving in the same direction, because while some segments are heating up, others are quietly starting to stumble. Not every part of the used car market is behaving the same way. In fact, the divide between winners and losers is growing wider by the month. On one side, you have categories that are practically bulletproof. Electric vehicles and luxury models have been holding strong, even climbing in value. Wholesale prices for used EVs have jumped by more than 12% year over year, while luxury vehicles are up nearly 9%. For sellers, these segments feel like gold mines. Demand remains steady, and the limited supply keeps values inflated. But then there's the other side of the market, and here's where things get interesting. Used Teslas, once considered untouchable in value retention, are now slipping behind the rest of the pack. For the first time ever, Tesla resale prices have dropped below the overall used car market average. The Cybertruck in particular has been hit hard, with some reports showing value declines of around 30%. Even the ever-popular Model Y has slid nearly 12%. For a brand that once dominated resale charts, this reversal is striking, and it hints at deeper cracks in consumer sentiment toward Tesla. This split in the market creates a confusing picture for both buyers and sellers. Some cars are still commanding top dollar, while others are suddenly affordable in ways they haven't been for years. And when you zoom out, it raises a bigger question. If certain brands can tumble this fast while others soar, what does that say about the so-called flood of vehicles everyone keeps warning about? And that brings us back to the heart of the mystery. Where did this dramatic 3 million cars figure even come from? And why does it sound so different from reality? So where did that explosive number, 3 million cars, actually come from? On the surface, it sounds like a fact pulled straight from an insider report. But when you dig into the data, no official source confirms it. Industry trackers like Cox Automotive and Kelley Blue Book all point to inventory levels closer to 2.2 million vehicles, not 3. That means the idea of an incoming flood might be less reality and more sensational spin. One possibility is that analysts or media outlets added up projected lease returns, rental fleet sell-offs, and repossessions to arrive at a scary-sounding number. Put together, those categories could theoretically reach millions of vehicles over the course of a year, but that doesn't mean they all hit dealer lots at once. Instead, cars trickle in slowly, absorbed by steady demand. To call it a flood is like saying a year's worth of rainfall is going to pour down in a single day. The problem is that headlines love big, round numbers. 3 million cars grabs attention in a way that tight supply and modest gains never could. But that gap between the narrative and reality creates confusion for buyers. Shoppers walk in expecting desperate dealers and slashed prices, only to find empty lots and rising costs. And when the hype collides with the truth, it leaves one big question hanging. If there's no tidal wave coming, why does the market still feel so strained? The answer lies in what's happening behind the scenes. Pandemic-era shortages, delayed trade-ins, and global factors that are keeping supply from catching up, no matter what the headlines say. The reason the flood never arrives comes down to years of pressure building behind the scenes. During the pandemic, automakers slashed production, and that ripple effect is still haunting the used market today. Fewer new cars were built, which meant fewer trade-ins and fewer lease returns to feed into the second-hand supply. That hole in the pipeline is something the industry has yet to recover from, and it shows in today's lean inventories. On top of that, many drivers are holding onto their vehicles longer than ever before. The average age of a car on U.S. roads has climbed past 12 years, a record high. Instead of trading in every 3 or 4 years, owners are squeezing more life out of their vehicles, waiting for prices to settle or interest rates to drop. That decision, repeated by millions of households, keeps fresh inventory from reaching dealerships. Then there are the global factors: tariffs on imported parts and vehicles, rising borrowing costs, and ongoing supply chain hiccups. Each one acts like a choke point, slowing the flow of used cars and keeping pressure on prices. Together, they ensure that even as demand surges, supply struggles to keep up. The result isn't a tidal wave of cars crashing into the market. It's a slow drip that never quite satisfies the hunger of buyers. And with those pressures unlikely to ease soon, the big question becomes, what does the road ahead really look like for the used car market? Looking ahead, the picture doesn't suggest a sudden collapse. It points to a market that will stay tight well into 2025. Automakers are finally stabilizing production, but it takes years for those new cars to cycle through leases and trade-ins before they show up on used lots. That means the shortage we're seeing today isn't going to vanish overnight. If anything, the pace of recovery will be slow, uneven, and heavily influenced by outside pressures. Analysts predict that inventory may grow gradually as more lease returns trickle back and rental fleets continue to cycle their cars. But the numbers suggest this won't resemble a flood. It will look more like a steady stream. And with consumer demand holding strong, especially for affordable and fuel-efficient models, any new supply will likely be snatched up as quickly as it arrives. Don't expect prices to tumble. At best, they might stabilize. For buyers, that means waiting for a massive drop could be a losing game. The apocalypse isn't coming, but neither are bargain basement prices. Instead, the market is heading into a new normal, one where used cars remain valuable, dealers hold firm on pricing, and only specific brands or models, like Tesla, see sharp declines. For sellers, it's still a strong time to cash out. For buyers, the smartest move may be timing and patience rather than hoping for a mythical flood that never comes. Which brings us to the big takeaway. If the market isn't collapsing, then what's really happening behind all the hype? And how should you play your next move? The so-called used car apocalypse sounds dramatic, but the reality is far different. There isn't a tidal wave of 3 million cars waiting to crash into the market. Instead, there's a stubborn shortage that keeps prices elevated and choices limited. Dealers aren't drowning in inventory. They're struggling to keep enough vehicles on the lot to satisfy eager buyers. What we're living through isn't a collapse. It's a squeeze, one that leaves shoppers frustrated, sellers confident, and the market stuck in a strange new balance. So what does this mean for you? If you're buying, don't expect fire sale prices or endless rows of cheap options. Be strategic, patient, and willing to move quickly when the right car appears. And if you're selling, the window of strong values hasn't closed yet, but it may not last forever. The apocalypse may make for a good headline, but the real story is about resilience, pressure, and a market rewriting the rules of supply and demand right in front of us.